chat with me today. It's July 14th, 2025. It's a TheoTrade video. And I'll tell you, we got a very interesting development setting up in the broader markets. The S&P seems to be just shrugging off any concern as we enter earnings season. And I say, let games begin because, man, I'm expecting to see some fireworks. And I guess 'tis the season. We got July 4th. In Utah, we got a holiday on July 24th where we got a lot of fireworks going on. We may see that in the market in the upcoming weeks ahead as we start to really take inventory on the potential impact of a diminished earnings expectation. And is the market going to surprise the upside and come up better? Are we going to absorb the tariffs? Is it not going to be an issue? We're going to get more data points on that, right? The effect of tariffs on earnings. We're going to get a sense of more of consumer credit, bank earnings, the state of credit generally. And everything kind of comes down to a couple of stocks that are announcing tomorrow. JPMorgan, for example, they're announcing tomorrow before the market opens. We also have Wells Fargo, who received a downgrade last week. Never fear, the stock's back to where it was. They have earnings yet tomorrow as well before the market opens. So expect to see a lot of potential movement. Now, what do we want to take away from these bank earnings? We want to see, okay, what are their trading revenues, right? Are they making money off of trading generally? That's an important, particularly in bonds, right? We've had a lot more volatility in the bonds market space because of tariffs, maybe foreign countries selling our bonds. We had a really nice day last week. It gave it back the last two trading sessions. Okay, we're gonna get on the mend there. The second thing we want to know from banks, we want to get a sense of how much are they making, their net interest income. So on their loans, what are they bringing in terms of returns, right? Income off of those loans. And what's the margin? So we've seen a little bit of bear steepening as long-term rates have gone up a little bit more relative to shorter-term rates. We'll see whether or not that's impacted them, how it's impacted them. And then we'll also get a sense of, okay, what are they setting aside in credit losses? One thing is about banks is that, they can pull money from their credit reserves or credit loss reserves and make their earnings look better. So what kind of monkey business are they going to engage in to maybe cover up for weaker earnings? One thing we do know, we've seen this over the last 2 weeks, some significant trades on banks. Bank of America, for example, huge, as we kind of went into the highs in here, huge size to the downside at the 44 strike, 46 strike. We're just kind of getting close to those numbers right now, right? Our earnings going to produce that. Now, this is going to occur the next day on the 16th, so Wednesday. We got inflation data. We got a lot of stuff that can really move things, move the bond market. But again, big trade in Wells Fargo. Well, it just shrugged it off and the downgrade. We're back to highs again. So a lot of stuff going on. But now we're finally at a point with the PE ratio of the market. So if you take a cyclically adjusted CAPE or Shiller PE, we're back at highs we haven't seen since July of 2020. Prior to that was where we were higher, but back in 2000. We're at nosebleed levels in terms of valuations, and yet you get probably the biggest contributors to earnings growth in the S&P over the last number of years. It's been technology and it's been financials. We're going to get a read on financials here this week, but we've already seen downgrades and lowered expectations for the Mag 7 names like Apple and Microsoft, for example. Can we hold up at record highs in the S&P 500 if we're starting to see this turn? I just don't think so. And obviously we have the August 1st tariffs. We have talk of 30% tariffs in Mexico and EU. Lots of stuff swirling around. And if we do not have the support of earnings, all that means is the market's more expensive today than it was 6 months ago. And so now we become more vulnerable. Now, what we saw today in XLF as an example, some sizable trade to the downside. Yeah, I got a rinky-dink position on this account here, but the idea is we're seeing some significant trade this week on the downside. 31,000 contracts traded today. Huge prints, buying puts in financials ahead of earnings tomorrow. Now, obviously, XLF's a little broader. It's got Visa and Mastercard in there, which, by the way, have already succumbed a little bit, right? Which isn't necessarily great for consumers. Big down day on Friday. We're kind of moderating a little bit here. MA, but putting lower highs on these products already. What happens if banks begin to crack? Well, this 0.25% increase in the SPY certainly is in jeopardy. And so what we're seeing right now is that the market itself, right, we're hedging a potentially large event, which I think bank earnings are certainly going to be one of those phenomenon that could move the market. Then we transition to earnings, right, into the Mag 7 companies over the next 2 weeks. Can we hold up, right? Those negative revisions that have pulled back expectations, is it enough? Can the market suddenly leapfrog it and find a way to move forward? You know, Don made a great point this morning about the S&P 500. Last week, we basically stayed within the range of the expected move, and now we're heading into a new week. We should breathe out expected move here. And the question is, again, how often do you see us stay within here for 2 consecutive weeks? Not many. We got one right back here in kind of mid-June, but generally speaking, you reach the extremes most of the weeks. So today we're basically sitting very close to Friday's close. Last week we stayed almost within the lower end of the expected move. Expect the unexpected, and we have catalysts this week that can get us there, right? Inflation, we've got earnings from banks. Expect to see volatility, and that's exactly what they're hedging in those XLF puts. Okay, we've seen trades in financials, we've seen hedges in financials, and again, all that's doing is trying to capitalize on downside movement or hedge the downside risk of the market. So folks, we got a lot of stuff to watch this week in the banking space. Take the key off that XLF. Recognize there are downside risks. Why did they pick today to buy those contracts? It's because they have earnings tomorrow or this week. Financials are going to come out. They're kicking us off in the earnings season. And again, I'm expecting to see some big moves. And again, we're going to see, are we rewarding beats? Are we going to punish misses more? We're going to get a sense, again, what's the state of the consumer? What's the state of the credit markets? Banks, how willing or able are they to lend? So much to assess. And again, so little time. But right now, what we do know is that volatility, if we look at the VIX, this gives us kind of the conditions of the market right now, very low volatility expectations, but better than yet to reflect expectations is look at the relationship of 3-month to 1-month volatility. And I use just a ratio of the 3-month to 1-month vol, and it gives you a more true picture. We just touched off last week on Friday at 1.2, which means what? We're looking at the 3-month volatility picture. It's 20% higher than the 30-day VIX. You don't get here very often. The last time we saw this was back on February 14th. And it's happening just as we're about to enter earnings season and getting kicked off with financials, where we've seen significant put option buying, which is reducing or trading downside potential in those names. Well, folks, we'll see how we respond this week. We'll see what we can take away, and I'll see you back next week on the Monday video. You have a great one.